My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people, my friends, just trying to make a little money. My job, not just to entertain, but to educate, teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Finally, we've got a market that's confusing the heck out of the bears. We just nailed down an A straight up day for the Dow, gained 125 points. S&P advanced 0.16%. Even the NASDAQ, okay, it dipped 0.03%. And this string's confounding a lot of people who don't understand that what certain public figures say is not necessarily what they mean. It's as though the whole thing's choreographed like a Netflix series. It's probably rated number 8 on the new release page. Although as exciting as this market strength is to me, I admit it's no Baby Reindeer or Man in Full. Oh, actually, the latter's not so good. So maybe our drama, it's a better watch. Let me go directly to the game plan so you know exactly why I say it's a Netflix drama, because I really got to get you involved with what's in my head right now, because I'm really kind of tired of hearing things and not being able to interpret them to you. For instance, on Monday, Loretta Mester, the president of the Cleveland Fed, speaks at 9 a.m. It'll be well covered, of course. She's both a hawk and a bear. Been one forever. Her talk with Philip Jefferson, the level-headed vice chairman of the Fed's Board of Governors, will give Mester a chance to articulate the most negative view imaginable. I predict it'll cause a sell-off because there isn't much else happening here, and you'll hear endless commentary and news clips about how the Fed's never going to cut rates. She's preternaturally negative. I wouldn't be surprised if she talked about the need to raise rates. That kind of chatter causes people to dump stocks and sends bond yields higher. I know it makes it so that everything's very unsteady, and that in turn keeps people off base. Not unlike what Neil Kashkari, the Minneapolis Fed president, who's bearish today and made people feel gloomier and more circumspect, did. I mean, this is the game. Or this is the drama, I should say. See, the sellers are allegedly fretting about the Fed's so-called timeline, whether there'll be one cut, no cut, two cut. These Fed heads make you feel like we are never going to cut rates, so the audience each time is stunned. But the real story is that the loudmouth Fed officials make everyone confused, cautious, worried, and at times just plain scared, which by itself causes the economy to slow down. That's the goal. See, the slowdown then becomes self-fulfilling, causing a rollback in prices everywhere. Hey, maybe from Home Depot, which reports next week, to McDonald's, where we're hearing about talk about a fabulous, cheaper rollback hamburger. See, the more these Fed officials entertain us with their hawkish commentary, as long as they keep us on the edge of their seats, well, the more likely it is that the Fed can cut rates in the not-too-distant future. The twist of the drama is that the more we hear from these hawkish officials, the worse the economy gets. And eventually we all win because the Fed needs a soft economy before it can cut. The old days they used to call, before Netflix, they used to call it jawboning. It's okay, but don't be fooled. You know what? Maybe we're in the prequel right now. Maybe that's what's happening with 8 straight updates for the Dow. These Fed officials either know the data's been weakening for a month now, the so-called brown shoots that I talk about, and they want it to get even weaker, or they haven't been paying attention and still believe the economy's going strong. Sadly, some of these officials don't do a lot of homework. Maybe they don't have the staff. I don't know. Maybe they're too theoretical. Maybe they lack context and contacts. All I know, thank heavens, is that the chairman, Jay Powell, is the opposite. He's not part of the drama. He's the real deal, not fictional. Thank heavens. And he does do his job. But no matter what, the Loretta Mesters need to keep up the good, scary, frightening work. Even though I think she's wrong, dead wrong, her comments alone do help fight inflation by frightening the heck out of business, which is always worried it'll be caught with too much inventory and not enough buyers. Hey, speak of the devil, Home Depot reports on Tuesday, and I really hope that they announce some rollbacks. Home Depot needs to play the role that we really want them to do for the American consumer. It needs to use its marketing power, its store power, to tell suppliers enough already. If you want to sell into our stores, you cut prices. And just tell us who's doing that so we can go buy their stuff. If the despot did that instead of just talking about the $18 billion acquisition of SRS Distribution, which I think they paid a fortune for, that's a builder's first source competitor. You know we like builder's first source. They'd make headlines and potentially do more business because American people want champions in the fight against inflation more than anything else right now. Or if you're more of a glass half empty guy, Americans have gotten cheaper. So we'll bring our business anywhere we can get a bargain. Alibaba also reports Tuesday, and we'll be watching because the People's Republic of China needs to show that as an internal combustion engine rather than just a whole economy built around exports, like it's cheap electric vehicles that are destroying nascent domestic EVs around the globe. Alibaba is a tremendous internet company. Really, my favorite, by the way, Chinese company there is, with the exception of maybe Zeekr, Z-E-K-R. That's a Chinese electric vehicle company that came public today and has some incredible cars and trucks. If Alibaba has a great number, I expect it'll be greeted with a lot of talk about how it's finally okay to buy Chinese stocks, because analysts can't resist doing that and they want the business. After the close, we hear from a company called Nextracker. We've had them on. It's a very cool solar technology company that makes solar power more of an all-day, all-year business. If we can put up a good number here, we're counting on CEO Dan Sugar to deliver it. You know why? Because Sugar is the delivery man. As you know, as you need to know, Wednesday, all you need to know right here, 8:30, CPI. Now, we often hear that the Fed's preferred inflation gauge is the personal consumption expenditures. They call it the PCE, But the CPI is the most visible reading, and we've had 3 hot ones in a row, which did a lot of damage to the market. Rent's been bad, insurance been bad, auto's not so great. This time, I think we're going to get a weaker CPI number. Now, here's where the Netflix drama comes in again, because the Fed heads are pretty much universal in stated worries about this particular number. They think this is going to come in hot. I think a weaker CPI will make skeptics understand why the market has been going higher for the last couple of weeks. And that should lead to a burst higher at the opening. Then the market will be really overbought, and then we'll probably go down. That's why it's been so great going in. Once we get the number about why it's been going in, there is a sell-off. Now, after the close Wednesday, not a bad one, don't worry. After the close Wednesday, Cisco reports, and that's the CSCO kind. And it'll be awkward if they can't give us a positive forecast because they can talk about the momentum of Splunk. That's a data mining company that we like so much that it just acquired. I hope CEO Chuck Robbins talks up his relationship with NVIDIA and how even though NVIDIA has a competing product, it still partners with Cisco. Hey, did you see the Arista Net? How cool that was today? Told you that was a good one. Now, we had talked to them yesterday if you missed the show. Now, if you want to know who could blow up its stock by calling for national every aisle rollbacks in price, well, it's one of my long-term favorites. It's Walmart. Now, Walmart reports on Thursday, and I honestly, I wouldn't put it past them to do exactly what I said. Now, I love these guys. Planning to go this weekend to Walmart with my kids because it's so darn fun. We go to a different one each time. Can you believe that we actually do this? And Walmart can already take credit for having lower prices. Remember my thesis. The Netflix drama gets resolved by the Fed chief ultimately needing to cut rates and being able to do it with credibility because of outfits like Walmart making it for a deflationary environment. Next, Deere stock is up, and its stock looks cheap, but I just don't know if it matters, given the fact that buyers can't resist owning an industrial with a good brand name. I know it's counterintuitive, but that's what happens when we're at this stage of the business cycle, the stage where you know anything machinery is about to run. I don't want to be in farm equipment, though. Remember, we spoke with the CEO of AGCO, a competitor, and he made me feel queasy about the whole group. I'm probably in the minority here, though. Now, finally, Applied Materials, the semiconductor capital equipment company, reports after the close Thursday. This morning, Taiwan Semi, that's the gigantic outsourced chip maker that's based in Taiwan, had some very good things to say. So Applied Materials, which makes machinery that goes into Taiwan Semi, could have a whiz-bang of a quarter. No wonder the stock, which is terrific, gained $3.40 today. The company's solid. The sector's great. You could do a lot worse than owning a stock of AMAT. Now, we also have 2 incredibly important analyst meetings thrown by Dow and Cracker Barrel. Now, I think Dow's doing extraordinarily. See that stock this week with the run it has? It's still got a good yield. They're doing extraordinarily well considering the weakness in the material stocks and in some of their grades of plastic. The combination of the dividend and the capital appreciation stream is hard to beat. But speaking of dividends, we're going to be watching the stock of Cracker Barrel to see if it cuts its very large payout. If it does, I know, again, counterintuitive, but you should buy the stock because that dividend cut is widely expected to happen. Friday, you know what? We have very little market news, unless somehow you think that my daughter Emma's 30th birthday is a factor. I know it'll be for me. But the bottom line, maybe we can see the end of the Netflix drama as it becomes obvious that there are more brown shoots than green shoots in the economy, and sooner or later the Fed's next move will be to cut rates. Seen the movie. It's a good one. Let's go to George in Missouri. George.
Jim, you featured the stock several months ago, and I bought a substantial number of shares, but the price of the stock has been basically flat. What is your prognosis for Honeywell?
I'm so glad you asked me. See, the stock went over 200 today. I was so glad. This is a very big stock for my charitable trust. And candidly, I've been very disappointed like you. I think they have a lot of things. I was hoping they would do an RTX the way they broke into Otis, remember that, and Carrier. Or maybe they could at least do a GE Aerospace, GE Healthcare, GE Vernova. So far, they've kept the model intact, and it's not working. I'm with you. They need to take action and take action now. Bob in Connecticut. Bob.
Hey, booyah, Cramer.
Booyah, Bob.
Thank you for what you do, Cramer.
Oh, thank you.
My question is about Morgan Stanley. I've owned it for several years, but my position has recently been called away. I want to ask you, should I wait for a pullback and repurchase Morgan Stanley, or should I look elsewhere in the financial sector for a different dividend-paying stock?
Let me put a little spin on it so that we can answer, then I can answer your question in an effective way. Jeff Marks and I talked about whether we should be selling the stock here. I said maybe we should let some more go. He said, Jim, it yields 3.5% and it's going higher. Let's do this. Let's split the difference. It's at 98. If the stock goes to 95, then I want you to buy. But otherwise, right here, don't buy. Fair enough. As it becomes clear that there are more brown shoots than green shoots in this economy, sooner or later, the Fed's next move will be to do some cutting. And they're setting us up for it. Mad Money tonight. You put CRH on our radar, and we were intrigued by the name. So after giving it our blessing a few months ago, the stock has climbed over 40%. I'm hearing what's working for the building materials company, my exclusive with the CEO. Very exciting. Then it's tough to believe people in this market, but I'm sharing the areas where I am seeing real strength and helping you stay focused so you don't miss out on an opportunity. And Recursion Pharmaceuticals has caught the eye of NVIDIA. You're buying SoundHound, forget about it. Buy this one, $50 million investment by the king of AI himself. And I'm learning how pharmaceutical research is being aided by artificial intelligence when I sit down with the company's top brass. It's a very speculative company. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
A little over 6 months ago, we ran a homework segment on CRH. That's an Irish domiciled building materials company. And after taking a closer look, I told you it was at least as good as Martin Marietta or Vulcan Materials. We've been recommending those for years. Those are the go-to names in the industry in our country. Arguably, I said, maybe it's the best of the three. Fast forward today, and I'm glad I got that question because, wow, CRH is soared up 47%, trouncing Martin Marietta up 38% and Vulcan up 31%. And that move includes a 4.3% pop today after CRH reported a strong quarter last night. And by the way, I mean last night because it was in the middle of the night. Well, this is seasonally the least significant quarter for these guys, and they made that clear a couple times. They beat on nearly every major line item, which makes for an encouraging start to the year. So let's take a closer look with Albert Manifold. He's the CEO of CRH. Find out more about the quarter and where his business is headed. Mr. Manifold, welcome to Mad Money.
Hey, good to be here, Jim. Nice to talk to you this morning.
I tell you, I got up pretty early to see how your quarter was because I was praying it was going to be a good one. I always like to have good news on the show, and it sure was. And I also learned, just so people know, you're a lot bigger than the ones we've been following, aren't you?
Look, Jim, we are the largest building materials business in the United States. In fact, we're the largest building materials business in the world. And in fact, if you look at our U.S. business alone, it's actually bigger than the next four of our competitors added together. So we, like our peers, we manufacture cement and we manufacture aggregate. We're very different. We convert those basic materials into end-to-end solutions for our customers. And we're here today in the United States faced with the largest period of growth ahead of us that we've seen for many generations, backed by significant government funding for infrastructure spend. We're off the back of 11 consecutive years of revenue growth and profit growth and margin improvement. We've had a strong start to 2024. Our first quarter is ahead of where we expect it to be, and that's continuing ahead into the second quarter. Looking for a good first half of the year. And all in told, I think this will be another record year for CRH in 2024.
Well, what I think is really incredible, and look, we're Americans and we don't do enough. I mean, not that we're xenophobes and believe in ourselves over others, but I had no idea how well Europe is doing too. I mean, I know we're bigger, but that's a pretty good book of business you got over there.
Yeah, look, we're the largest building materials business in Europe. the backbone of our business is actually our Central and Eastern European business, which is very much like Texas and Florida. High growth, high investment, backed by significant European funding for the infrastructure. And also we're seeing, as in the United States, the reshoring and the onshoring of critical manufacturing back into Central and Eastern Europe. And that's the backbone of our business in Europe. So that's going very well as well.
Well, I also be remiss not to talk about the business that would be regarded as utility capital spending, which is just on fire. You know, the utility index has been the strongest index in the last month. I think that they must be doing a lot of business with you.
Well, look, again, supported by government-subsidized spending. We've seen the IRA Act, Chips and Science Act, funding exactly in about power generation, the critical transportation of vital utilities and water, which is a very, very big business for us. I mean, a lot of the problems we have here in the US are we've got too much water in some parts of the US and not enough parts of the other parts. And what we need to do is we need to carefully and safely sequester the water where there's too much water and transport it safely away from the communities and try and channel it to those areas that need it. And that's a big part of our program for the next decade ahead.
Now, normally I would think that would trade with, say, residential, but they're very different. In residential, could be slower, obviously, but it's actually not as horrible as I thought, given the fact that interest rates in our country are pretty high and interest rates over there are still high, although they've indicated they're going to cut them in the UK.
Yeah, look, I mean, residential has been in a very challenged position because of interest rates for a number of years now. We're probably going to build about 1.4 million homes here in the US this year, but that's probably 300,000 or 400,000 below the ongoing need. And remember, we have a deficit of about 5 to 5.5 million homes as it is. So as soon as interest rates reduce, we expect to see residential recover quite strongly. In fact, in some parts of Europe, as you rightly say, interest rates are softening quicker than they are in the United States, particularly in the non-Eurozone in Eastern Europe, and we're starting to see residential perform very well there. So we're hopeful for that later this year or early next year. Now,
a lot of us are concerned that we may have already spent a lot of the money for, say, the IRA. I always hate to call it the Inflation Reduction Act because it's actually somewhat inflationary. But are we still in early innings for the rebuild, or has the money started to trickle out?
We are just getting to the end of the beginning.
Really?
I mean, what you're seeing here is the biggest investment program in America's infrastructure that we've seen since the New Deal in the 30s. It's very positive for the U.S. economy because you're building out the superstructure of the economy, which is the basis for economic growth. And on top of that, we're seeing, the onshoring and reshoring of critical manufacturing back to the U.S., which has been helped by funding by the U.S. government, and you're bringing back to the U.S. high-tech manufacturing in the area, chip manufacturing, bioscience, life science, pharmaceuticals, and all of this is building back the industrial base of the United States. So when you put those two together, this is a really very progressive program of investment for the next decade that will build the U.S. economy for decades and beyond.
Now, I want to make clear to people, you are not just a rock company. You do far more than that. You have a lot more intellectual firepower and property. So why don't you explain the difference between a company that just is trying to get the rocks to the driveways and to the roads and to the bridges versus you guys and what you do?
You're absolutely right. We don't just provide rocks or cement. We provide end-to-end solutions. So let me explain how that works in reality. So a big major part of what we do is road building. We're the largest road builder in the United States. We're the largest road builder in the world. So what our competitors do is they supply millions of tons of rock and dump it into the construction yard of our customers. Now, we do that too, but we also take that rock and we coat it with expensive bitumen and we make asphalt. We then pave the roads with that asphalt. We maintain the roads and we provide the culverts, the off-ramps, the on-ramps, and the bridge components for that. So we don't just make one sale, we have 6 sales. We don't provide rock, we provide roads. And that's why we're the biggest. That's where the highest profitability, the best returns, and the highest cash generation for our business. It's a different business model, but it's a better business model because we create higher cash and higher returns.
Well, sir, I got to ask you, how do you find workers? Because everyone tells me that the workers who would do your kind of business are in very short supply.
Well, actually, our business is actually about manufacturing products off-site and actually bringing them to the construction site so they will deal with the fact that it's difficult to have workers. We build modular components that where contracting companies actually put them together rather than build them on site. It's the future of construction because construction is changing. We need to build quicker, cheaper, faster, more resilient, and with less labor. And end-to-end solutions customers like ourselves are the ones who will do that. And we do, in doing that, we have higher levels of profits. better returns, higher margins, and crucially, more cash. We will have a treasure trove of about $35 billion of cash over the next 5 years. This year alone, we're investing about $5 billion growing our businesses through M&A and through capital expenditure, and we will return another $3 billion back to our shareholders. That gives us a fantastic powerhouse for our business, not to grow just not the organic business, but also to inorganic growth as well.
Well, I bet you're also a bargain for the government, for us, for the American people, because when we do it the other way, where nobody makes any money, it tends to be real bad for us, the taxpayer. I want to thank Albert Manifold, CEO of CRH Industrial. You obviously just heard this guy's the biggest, okay? And if you believe in infrastructure, this is Mr. Infrastructure. Thank you so much for coming on Mad Money. I'm sorry it's so late there. Thanks for staying up.
Well, you got it, Jim. You got it. Cheers.
All right. Mad Money's back after the break.
Coming up, from arms sale to salads, this market's tied some investors in knots. Cramer has a cure for the overthinking blues. Next.
Boy, it's tough to find people who believe in this market, even though it's had a major turn for the better. This is a bull market like no other, and it's stymieing both young and old. What's throwing people off? Other than the utilities, the strength isn't uniform. Each day has its own winners. They tend not to have any pin action. But they can make you a boatload of money if you see them coming. Plus, so many stocks that people give up on, in the end, come roaring back just a few days later. Take just yesterday, on Squawk on the Street, we had the CEO of ARM Holdings, Renee Haas. It's a semiconductor architecture company that's a key partner of NVIDIA. This company reported a quarter that was wildly panned because even though it delivered mostly terrific numbers, there was one disappointing line item. It was for chips for the Internet of Things, IoT. ARM stock was at about 106 when it reported it for the close Wednesday night. Then it collapsed to the high 90s shortly after the open yesterday. Bloom had totally come off the rose. Then we interviewed Haas. And he explained how the Internet of Things was weak, but he put it in perspective. Talk about how good 2026 and 2027 will be. Wait a second. That was terrific. The stock came off its lows and ended up down just a couple of bucks yesterday before roaring back today. Now it is actually up a few bucks since the quarter. That's what happens in a bull market, people. You buy the sell-off. You don't sell it. And you know what? You make some real good money if the sell-off's knee-jerk. Today, it's sweet green. The salad chain had been treading water for a long time with so-so same-store sales. Then these three guys from Georgetown reported a great quarter with beautiful 5% same-store sales growth and a terrific forecast. So what happens? The stock jumps 34%, like a takeover bid. Huge short position there made the move a lot more explosive. Sweet Green joins Texas Roadhouse and Brinker's restaurant stocks this quarter. They were rewarded with reevaluations. It also now falls right in line with Cava, a huge winner, and Chipotle, one of my absolute favorites. We do have a tendency to forget the pain and embrace the gain very quickly.
The house of pain.
Meta implodes on its quarter, falling 10%. Next, it's coming right back. Linde, symbol LIN, falls almost 23 points on what I thought was a decent call for the industrial gas company. And then, boom, ever since its stock just keeps plowing higher and higher. I know it's Charitable Trust name, so you can say, hey, I'm talking my book. But we wouldn't own Linde for the Charitable Trust if we didn't think it was going to go higher. This market's gotten so good that sometimes things go up for seemingly no reason. Look at Goldman Sachs, Wells Fargo, and JP Morgan. They just won't quit, but there's not a lot of underwritings or M&A. Fed's about to cut rates, inflation getting better, or are they simply rising as people stop trying to fight the tape and simply go with it? Unless you are a theoretical gas bag, it really doesn't matter, does it? Other companies put up decent numbers, and it's enough to propel their stocks much higher. Costco has broken down to around 700. Next thing you know, boom, 787. Blink of an eye. How about these industrials? Consider the wealth that's been created quietly with the merger and breakup of United Technologies and all the old Raytheon. You have Otis and Carrier and the new Raytheon putting up extraordinary sales, earnings, forecasts, and stocks. Same with GE, breaking into GE Healthcare, GE Vernova, and GE Aerospace, just quiet riches. Finally, there's tech, especially the semis. They bump along as leaders, then they fail, and then something happens. People talk about selling them. They're so proud. And then this time, for instance, we got orders from Taiwan Semi. They do monthly orders, the fab to the world. Suddenly, the whole semiconductor cohort blasts off with no qualms, as if there was never anything wrong, and all those sellers look like idiots. Yep, this is the kind of bull market behavior we haven't seen in ages. People don't know what to make of it. I do. When you get a bull market like this, and it is very rare, the most despised in years, I can tell you what to do. You ride it for all that it's worth. GT in California, GT.
Booyah, Jim.
Booyah. Booyah.
Hey, I wanted to talk to you about one of the stars of the day, one of the creators of about 90% of the chips in the world, helps manufacture for NVIDIA, Apple, and more. Today reported a jump in sales from previous April 2023, 60%. I want to talk about TSM.
And I want to talk about, because when I went over those numbers, I was astounded. You don't get a linked month that's powerful unless you got big orders from NVIDIA and AMD. They have the orders, they have the fabs, they make the chips the cheapest and the best. Very good call. Let's go to Sandy in Colorado. Sandy.
Hi, Jim. This is Sandy from Colorado. It is graduation season out here.
Oh, fantastic. And I hope all graduations go off as planned for the proud parents who have every right to be proud. How can I help?
Absolutely. My daughter's graduating from high school, going to college. So,
Yay.
Of course, we're thinking about dorms, decorating. So I want to get your thoughts on Wayfair.
Look, I think Wayfair is exactly the way you decorate a dorm. It's just, look, the stuff is good. We actually buy a lot of it because you know what? I mean, what the heck? I like a bargain like everybody else. I think Wayfair's terrific. Let's go to Bob. Oh, no, we have to wrap things up. But you know what? There's all in the next 7 years. And that, ladies and gentlemen, is the conclusion of a piece that I didn't count on. Not the lightning round. This is the kind of bull market behavior we haven't seen in ages. My advice, ride it for all it's worth. Much more mad money ahead. NVIDIA's Jensen Huang recently said, if I were to start from nothing, I would do it the way Recursion does. So we got to talk to these AI-enabled pharmaceutical company that is disrupting the space. We got the CEO. Then, as I just said, it's tough to find believers in the market, but look at what you're missing. I'm helping Cramerica stay focused and continue to win in this tape when we play Am I Diversified? And yes, of course, I'm going to throw in a lightning round because why not? I've done 4,000 of them. Stay with Cramer. We all know artificial intelligence can and will eventually change the world, but there are some industries where it's already made a huge impact, but you might not know it, like biotech, which brings me to Recursion Pharmaceuticals. That is a small clinical stage biotech company with an AI-fueled tech platform that uses sophisticated machine learning algorithms to help them with new drug discovery and speed it up. Doesn't hurt that Recursion has the most powerful supercomputer in all biopharma, as well as a partnership with NVIDIA that included a $50 million investment from the leading AI technology company last summer. NVIDIA is now helping them develop a second, even more powerful supercomputer. Of course, look, it's early stage, okay, so we always got to be careful. Their most advanced drug candidates are only in phase 2 trials. Remember, we got to get through phase 3 to make it all work. I'm going to again say it's speculative, but I like this story. I think it's a great story. One that shows us the future of the industry. Do not take it from me. Let's check in with Chris Gibson. He's the co-founder and CEO of Recursion Pharmaceuticals to learn more about what they're doing. Dr. Gibson, welcome to Mad Money.
Thank you so much for having us. Thanks, Jim.
Okay, so when I spent time out there at GTC with our crew, we spoke to Jensen extensively, and he brought you up many times. One of the things he did say was, if I were to start from nothing, I would do it the way Recursion does it. What does that mean?
Well, you know, today, 90% of drugs that go into clinical trials fail. And the reason is because biology is so complex. And so what we've built is an unbiased platform. We've got
now explain that. People are going to say, what is that, bias against certain people or race or whatever?
No, not at all. We want to make sure that we are letting the data drive our decisions as opposed to us making the decisions.
Okay.
So we've got a room just like this trading floor, full of robots that are doing the equivalent of my PhD every 15 minutes, generating petabytes of data, and then we're using ML and AI tools to look through all of that data to find new relationships across biology and chemistry that we can try and turn into medicines, especially for diseases that nobody else is working on.
Okay, so are there some diseases that might, if you use the old way, might take 20 years of your life, and instead you might be able to do in, say, 20 months?
Maybe. I think with clinical trials, there's still going to be a few years to get through the clinical trial space. But to find the drug and get it into the clinic, I think we can shorten that from 5 or 6 years and hundreds of millions of dollars into perhaps 1 or 2 years and just 10 or $20 million.
Oh, that's great, because drug companies have stopped taking you on hard missions because they know that 90% failure, and they don't want to lose money. So they don't take on the things that you and I both know have to be solved for families that just have a terrible situation. Why don't you give us one or two of the things that you're tackling that no one else was willing to go to because it's too expensive and too much failure?
I'll give you two. So
Okay.
one is we're going after a rare disease called cerebral cavernous malformation, which you probably haven't heard of.
No.
This disease affects 6 times as many people in the United States as cystic fibrosis.
Really?
But nobody understands how the disease really works. And so until we took this approach to use this automated platform with ML and AI, nobody really had an idea of how to make a drug. And now we've got a drug that's almost done with its phase 2 trial. We'll be reading it out next quarter, which is an exciting catalyst.
Wow.
And this is the opportunity of the kind of approach. We look like what we think the biopharma industry is going to look like in 5 or 10 years.
And what's the other drug? You mentioned you talked to.
So another one is we're working with Roche Genentech, one of the largest
big,
companies in the
fabulous
space.
company. We know that they have a good relationship.
They're fantastic, and we're going after all of neuroscience for a decade and one oncology indication. And in just 18 months from starting that partnership, we already found an exciting new opportunity in oncology. And I can't tell you a lot more about it, but it's a new, exciting potential drug that we're driving forward with our partners at Roche Genentech.
Now, neuroscience people have to understand, because I've done some work in the area, almost every drug company has given up. They just gave up because they don't understand the brain because it's too hard.
It's so hard. It's absolutely, I mean, it's littered with failures.
Yes.
But that's why we think this new approach of using technology to map biology, I mean, think of it as like Google Street View, driving around, taking pictures of everything. We have microscopes taking tens of millions of pictures of cells every week, and we're using a lot of the same AI algorithms to turn those images into mathematical representations of biology that we think could unlock some really exciting secrets.
Okay, now let me ask you, someone might say that sounds all well and good, but do they understand that it's not just about research? They got to produce something and make some money. They have about $300 million in the bank? This stuff
That's right.
costs a lot of money.
It does.
What are you going to do?
Well, that's exactly right. And so we have a whole bunch of partnerships that have the potential to bring us non-dilutive milestones, options, royalties. We think that's going to significantly defer some of our cash outlay. And then we also have the potential for new partnerships. We are talking to lots of companies, and we think in the near term we could announce some new partnerships that will further extend that runway.
Oh, very exciting.
These are great ways not only for us to subsidize our own platform that we're building, but for our team to learn from some of the best folks in the industry.
Okay, now let me just a shot in the dark here, but does Jensen ever come by?
Well, Jensen is incredible. We got to spend time with him at a big healthcare conference, JP Morgan, in January.
Sure.
He co-hosted an event with us. And our chairman was on stage with him for 45 minutes talking about biology. And what I found fascinating, Jim, Jensen was more fluent in biology than really any biopharma CEO is fluent in technology. And don't underestimate that guy, right?
No,
I mean,
never. Oh, no, a lot of people have lost some money underestimating that man. Now, how about you? Do you want this to be a major pharmaceutical company, or you want to be a major research company that works with pharmaceutical companies?
You know, we wanted to be a major research company when we started.
Okay.
But I'll tell you, one of our pivots have been that it feels like the industry's still moving pretty slowly. And
Yes,
there's
it
more and
is.
more opportunity for us to verticalize. And so unless the industry starts picking up its pace, you could see us start to become a more fully integrated biopharma company over the next decade.
Well, I'll tell you, I'm listening to you and I'm thinking younger people, like your kids who are here, younger people need to own a stock like this because this is a long-term fantastic idea that could revolutionize the whole industry.
We're in this for our career. The next 10 or 20 years, we're going to be building this.
Oh, I believe you are. That's Dr. Chris Gibson. He's the co-founder and CEO of Recursion Pharma. Now, the symbol is RXRX. I'm going to say it one more time. It is speculative. None of us would disagree, but that doesn't mean it can't be owned. We have money's back in. Right.
When we return, master the markets one stock at a time. The lightning round is up next.
It is time. It's time for the lightning round. Chris Cramer, Rock Roller, State Taylor, by myself, so some of you don't know the call stocks right. We play this them. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. We'll start with Naveen in Florida. Naveen.
Hi, Jim. How's it going?
It's going well. How about you?
Doing well. Thank you. Been a long-time viewer, first-time caller.
Thank you.
I'd like your take on Biogen,
You know what?
BIIB.
I'm not really impressed with what they're doing, particularly the dementia. I thought was going to be much better, dementia drug. I will point this out. It's really important. I think Eli Lilly's going to crush him in this business, and I'd rather see you in that one. Let's go to Joe in Maryland. Joe.
Hey, Jim, how you doing today?
I am doing well. How about you?
I'm not bad for an old timer.
There you
Jim,
go.
I'll tell you what, I just bought into a defense company not long ago, and I do value your opinion. And I'd like to know if you think I ought to buy more or just hold on to what I got. And that company would be Kratos.
Kratos, we recommended that like repeatedly when I was at 12, and it did nothing for so long. I am glad it finally moved, but let's keep it at the size that you have it, because that's had a very, very nice move, and I don't want to come in on top of it. Let's go to Matt in New York. Matt.
Hey, Jim, big booyah from upstate New York.
All right, good to have you on the show. How can I help?
Was calling to get your thoughts on a memory and storage solution company that's coming to upstate New York. The company name is Micron.
Okay, I like Micron and I like Sanjay Mehrotra. When's this start? This is a stock, by the way, that when it starts rolling, it doesn't just roll for a quarter or two. It rolls for a couple of years. We're mid of that move, just in the middle of it. Let's go to Brian in North Carolina. Brian.
How are we doing? We're going with Bank of America.
Yes, we are going to go with Bank of America, which hit a 52-week high today, yields 2.5. It is still way too cheap at 11 times earnings. Not done. Let's go to Brendan in New Jersey. Brendan!
Hello, Jim.
Hey, Brendan. What's happening?
I am calling in about a company that IPO'd.
Hello? Did we lose Brian?
Sorry.
There you go. Good.
Okay, I'll be quick. FIHL.
Not a favorite. Up too much. Don't like the cohort. Don't like insurance. Sorry. Let's go to Harrison in California. Harrison.
Hey, Jim. Thanks for taking my question.
Oh, absolutely.
Me and my buddy Steve we're both buried in this stock that reported earnings yesterday. What do you think we should do with symbol frog?
Okay, frog. I'm going to give you two animals here. I'll give you a frog and Datadog. Both of them can turn out to be too expensive. I would be a seller of almost all the enterprise software companies here. They are not where to be. They are yesteryear. Let's go to Brian in Texas. A lot of Brians. Brian.
Booyah, Jim.
Booyah.
Close to the 52-week high. Chevron. Any further upside?
Oh, man, Mike Worth is just driving that thing. That stock sees 200 before it goes. It sees 200. That's what I'm looking at. And that, ladies and gentlemen, the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, survive the unknown, thrive in any market. Cramer invites you to the Game of Games. Play Am I Diversified? Next.
All right, we do celebrate the market because we want you to make money, and the Dow just closed out its best week of the year and is higher for 8 straight sessions, which is amazing, just amazing. But as brown shoots continue to emerge this earnings season, you know, I think brown shoots are what we need because we need the Fed to cut. It's more important than ever to reevaluate your holdings, and we got to make sure you're diversified. Prepare for any market. Maybe a barbell strategy where you have some soft goods stuff and some heavy goods, and that's why we play Am I Diversified? This is where you call me, you tell me your top 5 holdings. I tell you if your portfolio is diversified enough. Maybe you got to mix it up a little, which is fine. I want to start with Anthony in New York. Anthony, you're our first caller. What do you got for me?
Jim, how are you?
I am doing well because it's Friday. You know that. Let's see my daughters this week and have a great time. How about you?
Should be a good Mother's Day and a happy Mother's Day to all those people out there.
I got to get something. Oh, my. I'll finish the show and then get something. All right?
All right. I just want to say how much I appreciate all that you do as far as installing your wisdom to everyone and teaching us all about the stock market.
Thank you. I mean, it is so not a trading show. It is so a teaching show. It's taken us 20 years to get to where we just heard what you said, and I thank you very much for doing it. You just made my weekend. Let's go to work.
Well, and I just want to let you know that your staff is excellent. Really
they are fabulous. Make me look good. I tell that to people. I would not look good without them. So, Let's go.
My holdings are Apple, Aon, Berkshire B, Eli Lilly, and NVIDIA. Jim,
Whoa.
am I diversified?
All right. Now, we actually have a little bit of a problem here. We're going to address, first of all, NVIDIA. That's an own it, don't trade it. We know NVIDIA, of course, is the king of AI. Eli Lilly, we know that's the king of the GLP-1s, the weight loss drug. We got Apple, own it, don't trade it. We got two own it, don't trade it. Now, Aon Insure, okay, a lot of reinsurance, and Berkshire Hathaway Insure because of Geico. But what I'm going to do, because they own the largest, but what I'm going to do is say that Berkshire is a conglomerate, and that's going to allow me to own Aon. So we can say we have conglomerate, insurance, tech, drug, and now you could say, well, listen, isn't that too tech? I regard this as consumer tech and this as business-to-business tech, and therefore it's different, and I thank you for the kind words. Now we're going to go to Mike in my home state of Pennsylvania. Mike.
Hey, Jim. Thanks for having me. My 5 stocks are Eli Lilly, Patterson UTI, Ford, NVIDIA, and United Health. Am I diversified?
All right. Well, Ford Motor finished under 12 today. It was frankly very disappointing. They got to do a buyback. Eli Lilly, we just covered them, but I'll add that they have this Alzheimer's formulation that we should hear about very soon. Patterson UTI. Now, I'm presuming that this is the Patterson that indeed is the drug, it's not the dental, but it is the oil company. So we have oil, we have tech, as we know, NVIDIA, obviously. United Health, does it conflict with Lilly? This is a health insurer, and this is a drug company, but they trade together in the health cohort, although sometimes, like when you trade on a cyber hack, it's still different, you know. So what we're going to do is we're going to get rid of United Health, and I want to substitute a true industrial, and the one I have my eye on is RTX. That's the one that was this Raytheon merger with United Technologies. I've been working on it all week, and I think it is so good, but it's getting away from it. That's what I'm going to suggest. Next up, we have Larry in Oklahoma. Larry.
Booyahski, Jim.
Man, fired up.
I think I've seen the movie Ted too many times. Hey,
that could be.
Here are my 5 stocks.
Okay.
Microsoft, CrowdStrike, Exxon, OneOak, and Apple.
Whoa.
Am I diversified?
Okay, so now we have to go back into, is Microsoft to consumer tech to go with Apple? I'm going to allow it because Microsoft and Apple are owned by my charitable trust, which, of course, you can follow if you join the CNBC Investing Club. Exxon Oil Company, I prefer Chevron to Exxon for the record. OneOak, that's Walter Hulse is the CFO there. He's unbelievably fabulous. This is a great dividend play, and I think it's terrific. CrowdStrike versus Microsoft. They are both in cybersecurity. CrowdStrike's just offered a program, an actual program to augment Microsoft, I'll call it, and that's George Kurtz, and he's terrific. So I'm actually being a little too loose here because I'm going to allow this cybersecurity, consumer tech, business tech, although, of course, we all have to use Windows, oil, and oil pipeline. And I know that people would say, well, listen, you can't have both those, but they do very different things. Here's what I'm struggling with, just so you know. My charitable trust owns Microsoft and Apple. How can I justify owning both of those and then tell you to sell Microsoft? So I'm not going to do that. Now, it's a tough game today because there are a lot of similar situations that I'm using new silos for. I like to say there's always a bull market somewhere. I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you Monday. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.